Hello and welcome to the Providence Quarterly Update for May 2021. My name is Michael Ogg and I'm joined as always by the Providence founder and CEO, Grant Patterson. Welcome, Grant.
Thanks, Mike.
Grant, I thought I'd start off with the title of the GOS, Global Outlook and Strategy. Sometimes it's better to travel than to arrive.
Well, that was a quote from a very good mentor of mine some 30, 40 years ago who used to quote that quite often. And really, when I was reflecting on where we are in the global growth story, I thought it might be apt. I mean, as the vaccines are being rolled out around the globe, global growth is expected to re-accelerate very strongly, up to over 6%. And we've also had, of course, a huge amount of government stimulus, fiscal stimulus around the globe, which is greater than the levels that we've seen since World War II. In the US, for example, $5.3 trillion of fiscal spending, 15% of GDP. They're very big numbers, and that started to be reflected in asset prices around the globe. We've got equity markets now in the States at record levels, PEs that are quite elevated, strong earnings growth expectations, a rising bond yield, booming residential property prices. So as the young child in the back of the car would often ask, are we there yet? My reflections are that there's a lot already built into the markets, and so perhaps it's been better to travel than when we actually get to the destination.
Thanks, Grant. So where does Australia stand in all this?
Well, Australia's in a pretty good position at this stage. I mean, fortunately, we don't have the levels of COVID that is around the globe. The government's been very forthright in the stimulus that they've given to the economy. So we've got on top of that very strong export income coming in from surging iron ore prices. The agricultural sector is in very good shape at the moment and good income coming through there. You've also got a booming domestic travel market. I mean, I think Australians normally spend about $65 billion in overseas travel. And obviously that's not happening at the moment. So some of that money is, coming into the domestic economy, which is creating jobs and providing very good support for regional Australia. So overall, Australia's in pretty good shape, and consumer spending is expected to stay quite strong and support the economy. So I think Australia looks pretty solid.
And Grant, tell me, what are the repercussions, if any, of this rebound?
Well, with global growth over 6% and the huge fiscal stimulus, the question's got to be asked about, interest rates and where they're going and where is inflation in all of this. We've already seen somewhat an adjustment with US bond prices going up, yield going up anyway, already coming through, and certainly within investment committees, a lot of discussion about inflation. At this stage, we think inflation is transitory from a low base. I mean, we're seeing some evidence of higher prices, whether it be through energy prices, through shipping rates quite high, lumber prices quite high. So we're watching that very closely, but at this stage, we think it's transitory. I think the other issue is, given the amount of global debt, and if we see this strong rebound coming through, I think you're going to see pressure on taxes, higher taxes. And we've already started to see that out of the US with the Biden's tax plan. So I would be expecting over time higher corporate taxes, higher personal taxes. And here in Australia, I think something that we've got to keep an eye on is whether there's any death duties or estate taxes coming in. I mean, that's why we've got the investment bond that we think looks quite attractive, because it doesn't form part of your estate. It's a very tax efficient vehicle. And so I think we've got to start thinking about, what the higher tax rates may mean for personal incomes and also for corporate earnings.
So Grant, given that backdrop, what does that mean for the current stance in portfolios?
Well, number one is that we're very highly diversified, because there's a lot of moving parts at the moment. We're value orientated within the risk assets. We're making sure that we're not long duration, so we don't have higher interest rate risk in our portfolios in bond rates, so that's called being short duration, and we're remaining very disciplined when we're having a look at the valuations of certain asset classes, and we've made a number of changes to the portfolios because of valuations.
Grant, if we can be a wee bit more granular, what does that mean for each asset class or the asset classes?
Well, I'll go through them. I'll start with equities, for example. I mean, you know, multiples are quite high from averages, and that's not surprising in such a low interest rate environment. Australia, for example, you know, is trading on about 19 times multiple. But the index, you've got to look through that nowadays. I mean, for example, the industrials in Australia are trading on a PE, ex-financials are trading on a PE of 29. But the resources are trading on a PE of 12. So that's why we're focusing very much on value rather than growth and looking for value in that area. In regards to global equities, US looks stretched compared to the rest of the globe, as you can see in the chart that's showing now. One of the areas that we quite like is the Japanese equity market. It's got quite a lot of exposure to increasing global growth and exporters as a manufacturer. Over 55% of their index is focused in that area. So we think that there's an opportunity as global growth accelerates that we believe that Japanese equities will perform quite strongly. I guess within fixed income, that's our biggest area of concern. As I mentioned before, we need to be careful of duration risk within government bonds, remembering that a 1% increase in a US 10-year government bond equates to a 6% decline in the capital value. So if you start seeing interest rates reflecting higher growth, then the bond portfolio is going to be hit. The other area that really concerns us in this world where there's excessive record levels of global debt is in the credit market. And as Jeremy Grantham has said from Grantham Mayo, in his belief, within the fixed income market, it's the greatest bubble that mankind has ever seen. So we'll keep an eye on that. Credit spreads are down to a level now where we don't believe you're being paid for a lot of the risk. And so we're being very careful in that area. We're underweight duration, as I say, underweight government bonds. We pretty much have no credit nowadays. But to boost the income in the portfolio, we think that loans is a very interesting area, whether it be first mortgage fully secured loans with property-backed securities, or whether it be cash flow lending to corporates that is senior secured loans. We think that that can give the portfolios a reasonable amount of income. Within property, the retail property sector has rebounded very strongly after COVID. Occupancy levels are back to about pre-COVID levels, and the managers have taken advantage of releasing the rents to achieve a longer while. So we've seen a good rebound in the A-REITs in the retail sector. And we've certainly seen it in some of our direct holdings in retail. Commercial property in the CBD, pretty uncertain still, not quite sure what that looks like in regards to vacancy rate. But interestingly, in suburban commercial, looks very strong as people have a now much more flexible workplace. Within residential property, we've all seen the huge rebound in the last 12 months. My only fear is what are interest rates going to be in 5 years' time? I don't know, but for a sample of one, I'm certainly locking in 3 and 5 year interest rates on my mortgage. And within alternatives, we have gold in the portfolio to protect the portfolios. The agricultural weighting that we've got is doing very well. Agricultural values are up about 14% in the last 12 months. And regional hospitality assets we think look quite attractive, particularly given the increase in domestic spending.
So Grant, can you just summarise where you're seeing the opportunities and possibly the threats as well?
Sure. I mean, within equities, as mentioned before, we think there's a good opportunity in Japanese equities to benefit from the global growth. We're certainly a value bias in equities, and we prefer active managers over passive managers, as we think there's going to be a big divergence between performance. Loans, as mentioned before, we think look quite attractive to boost the yield within the portfolio. Gold is something to protect the portfolio against any inflation scares is where we'd be looking at, and also in the regional hospitality market, as I said, that looks quite attractive to us. In regards to the risks, Mike, I think the inflation risk is one of the areas that we need to watch, and if we start to see a breakout in inflation or inflation expectations, it's likely that you'll see bond interest rates rise, which would undermine current valuations in risk assets, so we'd be cautious of that area. Also, with the massive corporate debt around the globe. We'd be careful in regards to insolvencies and defaults within the credit market. So that's also an area that we'd be, watching quite closely. In regards to the unwinding of government support, whether the consumer will continue to spend or whether they'll save the gains that they've received from governments is something that we would need to watch. Geopolitical, the Taiwan Straits and the issue with China and Australia and US relations is something that is quite troubling. I'm not quite sure you can do much within your portfolios to insure against that because it's an unknown, but it's certainly something that we will need to keep a close eye on.
So Grant, given all that, how have you found the last 12 months?
Well, it's been pretty intense, I'd have to say, but it's been an exceptional period of performance for the portfolios. So, very strong performance from the lows last year. So very, very strong gains. And so now we're very much focusing on protecting those gains over the last 12 months.
And Grant, is there any update on Providence you'd like to share with us?
Yeah, well, we're delighted that Will and Georgie Porter have announced the birth of their baby daughter, Sabella. Lisa is celebrating her 20th year at Providence, which is a great milestone. We've released the premises here in 20 Martin Place for another 5 years, so that'll be our home, which we're delighted about. The Melbourne office has had a very high level of inquiry and growth now that we're back to normal work environment, which I'm thrilled. James will be running the education series for our clients. Kids, so that'll be back on again in person. We've also had the client luncheons back on, reinstigated, and we were delighted to have over 80 of our clients with us just recently. And as you know, we've been doing a lot of work in the background in regards to an enhanced administration system, which we'll soon be talking to all of our clients about. So there's been plenty going on. It's been a fantastic 12 months, but now the hard work starts to make sure that we protect those gains, and we're looking forward to the challenge ahead.
Grant, thank you for your time as always.
My pleasure.
And thank you for your time. I hope you found it of value, and we look forward to seeing you next quarter.